Welcome back. With market volatility on the rise, it just strikes one that it is the broker who stands to make the most money. Does it? Brokerage stocks have moved in tandem with the overall markets, and in recent quarters one has also seen some pressures on brokerage commissions given the rising competition. Does this mean consolidation in the space is likely, or will such companies have to look at other diversified avenues of income? To discuss all of this and more, and of course also the market outlook, we have with us none other than Nirmal Jain, Chairman, Founder and Managing Director of India Indiainfoline. Nirmal, it's a pleasure to talk to you.
Thank you.
As always. Coming to your business first. Now let's take a look at how the turnover on BSE, NSE cash markets together. Now the combined turnover, how that has behaved. Yeah, there you go. Now, if we are looking at a one-year time frame, then we see a distinct trend in turnover cooling off. Now, you have maintained your market share in this market, but some analysts are concerned about what is happening to your brokerage yields, especially the net of service tax yield is pretty much below 7 basis points now for you?
Yeah. So it would be around that.
Right. So what does this signify? Do you think yields are going to remain under pressure going forward?
Yeah, yields have come under pressure in the last 2 years, in fact, and maybe the impact was seen significantly more in the last year and last quarter in particular. If you look at, we have two large significant segments of our businesses. One is our retail and the other is institutional business. In retail business, very broadly, F&O turnover now accounts for almost 80% of market volumes, and our share will be more or less similar, or at least will mimic the trend in terms of movement year over year or quarter over quarter, which was in fact only 65% about 18 months or 24 months ago. And cash market share accordingly has fallen from say 35% to 20%. And as all of us know, that typically brokers will be able to charge on an average 3 to 4 basis points on F&O and maybe around 10 to 15 basis points on cash market turnover. So weighted average yield has come down. Even in our, not in our, but maybe industry-wide, I would say in institutional business, if you see, there's a trend towards many large FIs and mutual funds are moving towards DMA. It is part of their business going to, in the direct market access, where obviously the brokerage yield will be significantly lower. I personally feel that this is a tendency when markets do not have a trend. And now whatever volumes, whatever mix change that we have seen in last few quarters may stay, but is unlikely to aggravate further. In fact, F&O is already 80% of the market, so I don't think it may become 85% or whatever, but it's not going to make material difference in terms of going forward yield on a quarter-on-quarter basis. So yields are already low, below say 7 basis points. So maybe this quarter I think they will maintain similar kind of levels, and going forward, even if there is a pressure, I don't think they will go down significantly. And one key reason is that from the investor's point of view, securities transaction tax now has become significantly more than the brokerage. So the impact cost doesn't change. So it's not that there's a pressure from customer in terms of pricing, but it's more because of mix change.
Yeah. Okay. Let's talk a little bit about your fund-based business. Now, your margin funding business has grown at eye-popping rates, and this that has really contributed to driving your entire loan book growth. Now, is that kind of growth sustainable going forward?
I think margin funding business has not really grown very that significantly, but it may appear so.
Okay.
Primarily, what had happened, if you go back, then the last year. Last financial year, last quarter was very dull and very bad for the market, and the sentiment was very low. So the margin funding book in those 1 or 2 quarters had come down significantly lower than what it used to be. But even now, our margin funding book is 1/3 of what it was at the peak, which was end of 2007. But of course,
that was not sustainable.
They were not sustainable.
Right.
And even the low which was made, say about year and a half back, which was in 2008 end or maybe 2009 beginning, was also unreasonably or unusually low. So maybe it has just jumped back to the normal level. But whatever margin funding book we are seeing, again will move in line with the market, but it looks more or less sustainable at these levels.
Congratulations on bagging the brokerage license in Colombo.
Thank you.
But why Colombo?
It's very interesting actually. When Sri Lanka, more than 80% people are educated, English-speaking population per capita income is significantly more than India. And this country has come out of long war of 25 years, has huge natural resources. So you see that when you want to get into broking, licenses take unusually long time. with the regulators. The economy was just opening up. So we thought that it's a good time to go. And in terms of ethnic population, cultural, they are very similar to what we are here in India. So we're looking, and it has been our strategy to go expand and geographically de-risk our business. And we want to expand in geographies where we'll be more comfortable. I mean, it's not viable for us to go to developed markets of Europe and US and compete with them. But I think Sri Lanka is a market which fits our core competencies.
But what about the market? Is risk aversion really for real? Because one part of the market does believe that if Europe were to go down, risk aversion is going to rise. But on the other hand, if it's the Western world which is in a financial mess, the fund flows are also going to flow into emerging markets like ours.
Yeah, it's very interesting to understand the correlation between the markets, and people say whether decoupling is happening or not. But if you really look at last 12 to 18 months, decoupling has already happened because our markets have significantly outperformed the Western market. So what happens when there's an event and there are jitters, that time everything falls. But when there's a recovery, then you will see that the markets which have fallen for fundamental problems like the Western markets, they don't rise back to the normal levels. But the emerging markets, and particularly the countries like India, China, they get back to their normal fundamentals. I believe that what has happened in the previous crisis, previous big fall that we saw, many FIs sold out, fearing that India will also see zero or negative growth, and there were many articles written by some Indians and some other people in the Western media that Indian growth rate will probably come down to 0% or 2% or whatever. Now they've seen that that is not correct, and 8% or 7%, whatever is not so significantly different. That growth is here to stay and is sustained. So I think that even now, like Lehman of this kind of a crisis that happened, if it happens again, and it's quite likely that maybe we may have some shock from the European economy. Yeah, no, we don't want it. But fact of the matter is that next 6 months, 12 months, unexpected things will keep happening. I think that Indian markets will not see that kind of panic what we saw post Bear Stearns or Lehman crisis. Because now, 3-4 reasons for that. One is that most of the FIs have discovered that Indian market in terms of growth are different, and at every dip they think there's an opportunity to buy, because those who bought at those abnormally low level have made a lot of money. Secondly, we also now are discovering that our insurance companies have a lot of money to invest in equity market. If you see last financial year, FIs sold out something like $16 billion, insurance companies bought $16 billion. And a lot more money is coming in. And thirdly, domestic story is here to stay, which is, see, India's fiscal deficit is financed more by domestic debt, which is very unlike, say, European or US market where the fiscal deficit is financed by external debt. So we are that way reasonably, cushioned and immune from, I won't say that there won't be any impact. I mean, there will be an event impact, but that will taper off, very soon.